Glyn, here we are just before the close of the final day of the May's markets. It's a good opportunity to reflect on what's been going on. It's fair to say there's been a lot of macro news over the course of May. Would you like to start by sort of summarising the world as you've seen it?
Yes, look, the news that's just broken, which was actually not a great surprise, but I think is quite sobering, is the fact that the US economy, rather than growing by 0.25% in the first quarter of this year, actually shrank by 0.7%. And as ever, it's the US economy that is by far the most important in the global sort of scene. And that has had quite important implications. It's been quite clear the US economy has gone through a soft patch. We've talked about it before, and we know there was severe winter weather. We know there was a problem on the West Coast ports with a labour dispute. The strong dollar has affected the economy. But the big question now is, was that just a transitory thing, and is the economy about to sort of pick up? Or is that a more fundamental change in the growth rate of the economy? And that feeds through to so much else, including, of course, Federal Reserve policy.
Conversely, we've got the likes of Europe and Japan looking actually reasonable from a growth perspective.
Well, the interesting thing is we've had this convergence of economic activity for quite some time. The US was outperforming everywhere else by quite a big margin. Now we've seen Europe growing actually not rapidly, but certainly picking up, and the trend has been much better. So on an annualized basis, they grew by over 1.5% in the first quarter. Contrast that with the US, which shrank. Japan had a very good first quarter, grew by nearly 2.5%. So things are beginning to work for them, and I think currency weakness is definitely having an impact on those economies, whereas the reverse has been true in the US, of course. So it's definitely better growth outside the US, but again the question is, how sustainable is that? Because we know there are still those big headwinds. We know there are structural rigidities in Europe, and we know there's simply too much debt around still, again in Europe, but also Japan has got a problem of debt. So we're not looking at high sustainable growth rates, but definitely a tick up, and as I say, this big question mark, will the US now begin to pick up? We think it will, and the data coming out recently from the US, the forward-looking data, whether it's housing starts, consumer confidence, it's pointing towards a pickup in growth as we go through the rest of the year. So we still see this as a period of improving growth in the developed world, but relatively sluggish compared with previous cycles.
And this, of course, is key when looking on central bank policy, where you've got a continued divergence, in fact, of activity.
Absolutely. It's absolutely key. And there's no question that the markets are going to be increasingly focused on what the Fed is going to do. It was only a few months ago, of course, that people thought the Fed would have its first interest rate rise in June. That's not going to happen. This slowdown in the economy has stopped that. But there is equally no doubt that the Fed wants to begin this process of policy normalization. It wants to start raising interest rates. On the assumption now, and we think the economy will tick up a little bit. As I say, the numbers coming out have been pointing to a pickup in the economy. Our best guess is the Fed will actually now raise rates in December. That's the most likely target date. So broadly where the market is expecting rates to start to rise. And of course this will be the first rate rise in the US for a decade. So the way markets react to that is going to be quite significant. Treasuries came under a bit of pressure when it became clear that the Fed was still talking about raising rates in the course of the next few months. Very, very important move this is, of course. So something that I think as we approach that date, investors are going to be focusing more and more on.
Let's move then to Europe, and another central bank, of course, who are having their minds exercised at the moment, but particularly with respect to Greece. They've got no money left, basically.
No, Greece, look, is bust. I think we all know Greece is bust. And they face this repayment schedule, which is punishing. They've elected this left-wing government, which is refusing to accept the austerity program that the Germans and the rest of the Eurozone are imposing upon them. As it happens in the course of June, they've got 1.6 billion euros to repay, mostly to the IMF, and they don't have the money. They'll only have the money if the Troika, those big institutions in Europe and the IMF that have lent money to Greece will actually relent a little bit and free up some money. I actually think this is now coming down to a political decision. As I say, it's beyond dispute that Greece is bust. Ultimately, there's going to have to be some further debt rescheduling. So the short term is all about Will the rest of Europe relent a little bit, release some money, enable Greece to repay its debts in the course of the next few months? It's been a daily saga, quite frankly, that impacts on the markets. But the one thing I would say is that 3 or 4 years ago, if Greece had gone bust, it would have been very damaging. Today, nearly all of the debt is owned by the Troika. Very little Greek debt is owned by banks outside Greece. So the systemic impact is pretty low. But nevertheless, this remains a significant worry for markets generally. So something to watch out for. Lots of noise, but ultimately, as ever with the Eurozone, there'll probably be a muddling through until we get to the stage where there can be a proper rescheduling of debt again in Greece.
Moving from a relatively small economic player to a very big one, of course, China's GDP news has been relatively weak over the last few months, and yet the stock market is doing extraordinarily well.
Well, we've had this extraordinary move in China. As we've been saying for some time, the economy is slowing down. That's quite apparent now. Growth rates of 7% are going to be a struggle, and I think as we go through the next year or two, we'll still see some slowing down. The data has been quite weak coming out of China. But what the Chinese authorities have done in response to that is that they've loosened monetary policy, they've cut interest rates again this month, they've freed up some money for infrastructure spending. So in a way, bad economic news has been good for markets, but you'd expect markets to perhaps behave in a sort of slightly more rational way than they have in China. The Chinese markets, well, at one stage this month in May, they were up by 20%. There was then a big setback at the end of the month. They've doubled in the space of 7 or 8 months. And a lot of that has been driven by speculative retail activity, lots of new retail accounts, lots of margin buying. That's dangerous. But as you rightly say, a few years ago when China was relatively small, wouldn't have impacted the rest of the world. China is now nearly 20% of the global emerging market equity index. So if China does have a big correction, that's going to have an impact on emerging markets, generally speaking, and certainly on the index level. So we're pretty cautious about what is going on in China at the moment, and it's right to be cautious when you've got a speculative boom of this magnitude.
On the subject of caution, perhaps, the UK general election produced a surprise result with the electorate not only staying with the status quo, actually an enhanced Conservative majority.
Yes, look, it was quite. We always thought that the Tories would form the next government, but it was looking through the polls right up to the date of the election. It was looking as if they would not get an outright majority, and indeed there were quite serious concerns about whether they would actually form the next government. In the event, the great silent majority in England, in particular, voted for the Tories en masse, pretty much. The Labour Party had a disastrous result, and we've now got, although it's only a small majority government, we've now got an outright Conservative majority government with a very clear mandate. I think it's extremely good news for the UK economy, for the UK stock market, for sterling. You know, we've now got a government which is intent on fixing the debt problem. It has a clear mandate to do so. It's pro-business, pro-reform. There's only one sort of uncertainty ahead, and that is the fact that will now be a referendum on in the EU, whether we stay in or out. That's part of the Tories' mandate. And I think there will be some wobbles, particularly in sterling, as we approach that date, which will be the latest 2017. My best guess is that, as with the referenda generally, there's a sort of a tendency to vote for the status quo, and I think that the negotiations that the government is going to have with the rest of its EU partners will produce enough for the government to be able to strongly support staying in the EU. So I think that will be the end result. So a little bit of a glitch to come, but generally speaking, I think the UK is in a very good place for the next 5 years.
So as we said at the start, plenty going on from a macro perspective this month, and yet the markets were a bit more subdued compared to April.
Yeah, there wasn't too much movement in markets apart from China. We've seen this continuing trend of the European markets and Japan, which had a good month, up about 5%, outperforming the US, which is up about 2%. So far this year now, Europe and Japan in local currency terms are up by about 20%, so this has been a really good start, whereas the US is only up by about 4%. Still generally pretty good all round, and I think it's been encouraging as well to see the fact that equity markets have been outperforming bond markets. Bonds, government bonds in particular, have struggled a little bit. We had that very sharp backup in yields from mid-April to sort of the middle part of May, And I would say there was some sanity coming back into bond market valuations at that stage. Yields have settled down since then. So I think the trends have been quite encouraging. But I would say this: I think that a period of consolidation is probably overdue. I think that there's probably enough uncertainty about the economic trends in the US in particular to cause people to sort of step back and wait and see, take that sort of approach. And of course there's going to be a lot of watching of the Fed, watching their next moves, what they say about the next rise in interest rates. So I think we're probably in a period of some consolidation here now. But having said that, we know for sure there's still going to be a lot of liquidity around. We know the Bank of Japan and the ECB are going to continue to pump money in for the next 12, 18 months as a minimum in huge quantities. And I think that's going to be very supportive of markets. And I think this sort of sluggish but continuing growth in economies is not a bad environment overall for either the corporate sector or this sort of interest rate trend, which we've always said is lower for longer. So period of consolidation ahead, I think, but still markets have got some way to go upwards before this cycle concludes.
Great, thanks.